Now, one of the types which is commonly made aware of or commonly talked about is mutual fund. What is mutual fund?
Well, I will say a basic and ideal
Okay.
question that everybody should know. See, mutual fund is an investment vehicle. The moment I
Mhm.
say investment vehicle, that means you are using the
Okay.
investment vehicle, that's a mutual fund, to enter into capital market. But you may say that I can
Correct.
directly go to the capital market. Yes, you open a demat account, go to the capital market. You can buy stocks, you can sell a stock. But then you will have a lack of someone's assistance there because you are fund manager yourself. You know everything if you are managing yourself. So mutual fund
Mm.
provide intermediary service. You are entering into the scheme of mutual fund. They have a fund manager. They will
Mm.
put that money into the capital market in the equity and debt segment. They manage the fund. They minimize the risk. They maximize the return. And
Yeah.
then that money appreciates. It should be ideally,
Okay.
and the value will come back to the scheme in the form of net asset value. And then this
Right.
value is gone back to your
Certainly.
account in the form of dividend or capital gain. So this is a complete circle. So mutual fund is
Mm.
basically a financial intermediary doing a fantastic job for anyone who
Okay.
does not have a time, does not have a skill, have a lesser
Ah.
money, could be distant places and all, does not have access resources. Put
Okay.
your money into mutual
So,
fund and
so
let them
you
handle and
recommend
manage that to go into the
anyone
capital
who is
market.
beginning or starting their personal finance that they start with mutual funds because it's less riskier. That's great.
It's a better way.
Correct.
It's a better way because mutual fund has got a
Uh,
range of schemes. They have a range of fund managers who are in
uh,
fact disciplined by the offer document. And what is called offer document is a
okay.
legal document. By that, they are disciplined to invest in the
Mm.
capital market. So this offers you great facility. And the best part is that at the cheapest
Uh-huh.
expense that you get
Okay.
it. That is also
Okay.
a
So, do you
thing to be
have any
considered
drawbacks
while
for
you are
mutual fund? Do
investing.
you see any
So mutual
drawbacks?
fund is good. Yeah, certainly you have a drawback. The first problem is that there are 50 mutual funds in India. And if you ask them for the number of schemes put together, they will have a not less than 2,000 schemes.
Yeah. True.
And then you choosing one scheme out
Yeah.
of this 2,000 is the very biggest problem in that. That's the very big drawback. The second drawback
Uh,
that I will say, it's a
absolutely.
fund manager choice about the market portfolio creation. You cannot dictate your term. It's not as per your
Right.
custom, your choices. It's a
Uh,
standard portfolio. That is what they will always be able to make it. So if you feel fine, it's okay. If you do not feel fine, you have to exit it out.
mind
So
me.
that is the drawback as well. But then these
Correct.
drawbacks
Correct.
are minor.
So, what
This
are the
can be always
biases,
go
common
by with the
biases
major
you
profit that
see
you can have.
when it comes to investment?
Huge biases.
Right.
Everybody has got biases. All of us are emotionally immature. We
Uh,
can be see we There are two words we call fear and greed. Everybody is fearful, everybody is greedy. So fear and greed is only a process of weakening us, and that brings
uh,
all form of biases. Simple biases, I will tell you one or two here, for example. One is called herd mentality. We are all safe in number. You will simply see it among the crowd, nobody will speak. When one
correct.
person speaks, then second, third, fourth, fifth, and then everybody speaks. It's a herd. So when one person invests, second, third, fourth, fifth follows, and then everybody invests. So when market actually goes up at the top, you will find everybody coming to the market. When market goes back down at the market, everybody come out of the market. So the herd mentality is the biggest biases. There
Yes.
are many biases, and we are all
Okay.
impacted
Okay.
because of a degree of our engagement with the fear and greed factor. So this part needs a lot of discussion, lot of workshop. People should realize their
Okay.
errors or biases where actually they are not able to take rightful judgment,
Important. Yes.
and that
Absolutely.
impacts your
Very good point.
earning potential
We
in
have,
finance.
financial market regulators. Who are they? What are their job and responsibilities?
Yes. See, we have in financial market, there are
Yeah.
four regulators in India. One is SEBI. They are regulating the capital
Right.
market, and all tradable instruments are being regulated by SEBI. Then we have
Uh-huh.
RBI. They are regulating all the banks and non-banking finance company. We have a IRDA. They are regulating all life and non-life insurance companies. And then we have a PFRDA that is regulating pension fund in India. So we have four regulators for different sectors. They are doing extremely good job. I will say I have a best compliment for them. They have been able to see that a country like India, where awareness and literacy of financial literacy is so pathetic, People even do not able to write their complaint and to the address it to the rightful person. That's the biggest problem at this. But still, they have been able to see that largely it is a more or
Okay,
less
you mean to say that they
absolutely
are
regulated.
actually
I will
helping the
say they are
ordinary
doing perfect
investors
job.
more, right?
Yes. Yes. In
Right.
fact, anybody has got any problem in any of their deposits or investments. So uh, the minimum that they can do is that they visit the website of these company. You have a complaint section. Go
Okay,
and write a complaint. You will find it will
fantastic.
get resolved. Definitely, it will
Okay.
get resolved. So this
Yeah,
much at least people
that
should
will
know,
come with,
but people do not do this
I
also.
think, awareness. Okay, people are to be made aware of these regulators and how
Yeah.
important are they. I think SEBI already has a couple of ads where they in television where they ask people to come back in case they have any queries. So such similarly, other modulators should also come forward and put out posters or put out notifications that. If you have any questions or investments, you can directly come back to us. I think these kind of awareness are to be made, and people would follow these regulators. Now comes the broader aspect of the finance, which is the when you say mutual fund, there is a lot of concept about diversification, asset allocation, and portfolio management. So what are they? They sound big words. Okay, what are they actually?
Yeah, these are technical words being used in the mutual fund industry, but meanings are very simple. Maybe application could be looking to be a little complex, but meanings are very simple.
Okay.
See, mutual fund, we are putting money into mutual fund and they invest in capital market. So when they invest in capital market, where do they invest? They choose equity, they choose debt. So that is called asset class, investing in different types of asset. For example, we are putting say some money in house, some money in gold, some money
Okay.
in bank deposit, some money in equity. So this is different type of assets. So asset allocation is about distribution of
Oh,
your
oh,
investable amount in
fine.
different type of assets. That's asset allocation that mutual fund does. Then comes diversification.
Ah,
Diversification is the best method to reduce the unsystematic risk. Little complex word, but still, if you are suppose, for example, if you are saying if you are investing in one stock, your 1 lakh rupees getting into only one
mm,
stock.
mm.
Let us say example, stock is Infosys. Wonderful return you got.
Yeah,
Stock is something which is like a which has not done a good. Let me not let's say
yeah,
Jet Airways or say Kingfisher and all, and they ran away with the money. So a good company will
ah,
give you great performance. A bad company will give you very bad performance. So
ah,
to just take it off is
fine.
that you put money in different stock. That is a diversification. So distributing money across different
Manner, okay.
security is called diversification, and mutual fund does this in a splendid manner. So
Okay,
diversification, asset allocation are the different method
okay,
of approaching
fantastic.
how the
And
mutual fund
what about
approach the
portfolio?
capital market.
Portfolio management. Yeah.
So portfolio management is how
Okay.
you operate portfolio. Portfolio is basically the
Mhm.
collection of securities. Now see, in mutual fund, you
Yeah.
invest in schemes. Schemes pools together, suppose they are 1,000 crore rupees. Now 1,000 crore rupees will not go into one stock. It will go into 50, 60, 70, depending upon the fund manager view and the offer document
Correct.
mandate that they have. So they will go into 40, 50, 60 stocks. So collection of all those stocks is called portfolio. No, a simple word we always say no.
Ah,
In if you go
correct
to the
enough.
college, they will say my portfolio of photographs, collection of photographs. So similarly, it's also a collection of
Mhm.
securities, and that is what we call portfolio. Every scheme will have a portfolio. So portfolio performance, portfolio management, portfolio risk,
Okay,
portfolio
fantastic.
return.
In
These
mutual
words
funds,
have been
when
secondly
I have seen in a
discussed.
couple of platforms that there is something called asset allocation and asset rebalancing. Okay, what are these
Yes.
terms? And can you please?
Yes. Yes. Asset allocation is
Okay.
distribution of your investment amount in different assets. That part was clear. But rebalancing means suppose today you decided to have a 50%
Yeah.
equity, 50% debt because you feel
Mm.
that this distribution is okay. Tomorrow market goes up and this 50% becomes 70% and you feel market has gone
Uh-huh.
up. You feel you're a fund manager. You feel market has gone up. It is now more valued. So I should withdraw some money out of
Fine.
that and
Mm.
put into debt. Why? Because market has gone up. It's a little costlier now. Whose view? Your view.
Uh-huh.
So what you will do, you will sell equity, will buy debt. That's a rebalancing. Could be other way.
Okay.
If market has come down, equity value from 50% has gone to 30%, and then you feel, oh my God, equity is now under valued. I should put more equity. From where you will get the money? You will sell debt and buy equity. So this switching
Okay. So
across
this has to
different
be done by
asset
the fund
class is
manager,
called
and
asset
the common
rebalancing.
does not do
Yes, it is done at the level of fund
fund.
manager. Ordinary investor does
Okay,
not
great,
require
great.
to put so much
So
of
in
mind into
the
that. It
initial
is being taken care by them.
journey of this podcast, you mentioned a word called equity. Okay, can you please elaborate a little on equity? What is SIP? Because when it comes to equity, people
Yes,
tend to relate to SIPs. So how important is SIP? What is SIP and what is equity?
yes, sir. Yeah. Yeah. See, first of all, equity. Equity is a global word. You go to any country in the world, if you say equity, they will understand because it's the language they understand. Equity is
Uh-huh.
just the ownership in a company, in any business. Suppose you are starting a business X, and then you say, I need 1 crore rupees, and I say, I will also give you
Fine.
10 lakh rupees. So you will say, okay, 10% ownership in my company. So if I make a lot of money, I will share the
Fine.
profit to the extent of 10% with you, proportionate sharing, ownership. If I lose money,
Uh-huh.
you will also have to take loss by the extent of 10%.
Hmm.
So equity is a proportionate ownership in any business, any firm. If
Money.
you have a lot of money, you can start your own, but everybody does not have a lot of money. So they pool the money
Hmm.
together. So equity is a method of raising capital in
Okay.
capital market through a proportionate ownership basis.
Yeah.
And then if you're investing in a good equity, fantastic, it will give you good return, but it does not happen always. So what happens is that we are
Yeah.
investing in the form of a portfolio,
Ah.
which we discussed earlier. And the second thing is that we invest regularly.
Okay.
Regular investment, that is called SIP. SIP
Fine.
is nothing but it's a method of
Uh-huh.
investment in equity or equity portfolio where you are disciplining yourself. Disciplining means what? Suppose you say that I am doing a recurring deposit in the
Hmm.
bank. So discipline is that every first of the month I will have a salary
Hmm.
and I will put 5,000 rupees into the recurring deposit of a bank. It's a disciplining. Similarly, here also in mutual fund, they will say, let us identify a date. You will say 5th of the month,
Uh-huh.
or every month, every 5th of the month or 10th of the month, whichever date you have a mandate
Hmm.
given, they will take out some money from whatever amount the mandate you have given,
Hmm.
money, and then put into the schemes of mutual fund. So this regular investment, periodic investment,
Okay.
this method is called
Uh-huh.
systematic investment plan, and
Yeah.
that is SIP. So a scheme is different, mutual fund is different. Investment methodology
Hmm.
is called SIP. So you are investing in the
Okay.
form of regular periodic
Great.
investment that
So
becomes SIP.
now you mentioned the
Very
word
popular
scheme.
method.
So what are the different schemes of mutual fund in mutual fund?
Oh, huge number of schemes. And a mutual fund,
Yeah.
see, I will say classification very briefly. I will say because it's a very big subject. You have an
Okay.
open-ended scheme, you have a closed-ended scheme, you have a hybrid scheme, you have equity schemes, you have a debt schemes, you have a hybrid
Okay.
scheme, open-ended, closed-ended, interval scheme. So many
Yeah.
classifications are there. In fact, if I
Okay.
say only equity schemes, there are 11 type of schemes. In debt, you have a 16 types of a scheme. In a hybrid, you have a six
Okay.
types of a scheme. So there are a huge number of schemes. That is why I say
Yeah.
that plethora of choice, too many choices are from the
Right.
mutual fund. And that is
Hmm.
the biggest problem for an individual to identify, to segregate, to locate which scheme I should. And I will say here, there are a lot of distributors and advisors in the market.
Okay.
They are technically trained.
Hmm.
They have to pass certain examination. It's a very good business revenue model. And you can take the assistance of those guys also if you do not have expertise or time with yourself. But if you have expertise
Okay.
and time with yourself,
So
you can do
how
it
do they
also
find these
yourself. This
trained
is not a big.
guides? How if an investor need to invest 10,000 rupees in a mutual fund? How do they? How should they start?
I will
Yeah.
say if they have to use a word start,
Okay.
they are the new investor, they should do by the only SIP route. SIP route is the best way because thereby
Yeah.
you are able to get benefit of volatility. Not volatility means rate of change of price. Thereby you are able to get the benefit
Okay.
of volatility, not that you are going to lose
Uh-huh.
out of volatility. So SIP is the best way for any new investor. Otherwise, I will suggest that distribute it. Suppose you have to do one-time
Hmm.
investment. You say, I do not have commitment of SIP that every month I will pay. Then distribute
Uh-huh.
it across different mutual fund, different schemes, types of schemes, or you can leave equity, can go into the hybrid segment
Okay.
where you have equity and debt also together. So that's a little less risky. If you are in
Uh-huh.
different age group and you feel that you cannot take even element of risk, in that
Okay.
case, you can go to the debt schemes of mutual fund. They are very less risky. So
Mhm.
depending upon the grade of risk that you have, the way you perceive and define yourself, you
Oh,
can design and
uh,
define your investment in different mutual fund schemes. That's a little
Yeah,
a
we can
longer
get into
subject, bigger
that in
subject
a
to
different
deal with.
episode maybe. For now, for an ordinary investor, what are the best schemes you suggest to invest or recommend?
Best scheme selection, no?
Yeah,
It's again very difficult because the word I use, the risk and the uncertainty. And which SEBI also says that
all
you
right.
please publish this. Past performance may or may not be the future performance. No. So capital
Hmm.
market and mutual fund schemes
Uh,
performance, if you have seen in the past and they are doing wonderful, extremely good,
yeah.
it does not mean that they will also be doing the same consistency hereafter. So what
Okay.
we suggest is that
Yeah. Right.
you should first identify your financial
Hmm.
goal. That's the first criteria. You should see your first financial risk. And then you build up a
Hmm.
portfolio. Portfolio scheme should be something which is a consistent performance. I have seen consistent performing schemes has given you better result in your portfolio than the best performing scheme. Because what is best
Right.
today will not remain best tomorrow. And so you will have always the
Completely.
average out performance. So better find out the consistent performer of
Hmm.
a scheme. And I suggest you that you go to the any fund house website, you will find a document called
Okay.
fact sheet. Every fund house has got a document called fact sheet.
Right.
And you download that fact sheet and you will find the performance of those schemes
Okay.
in the basis of last 1 year, 3 year, 5 year, 10 years since inception. So
Print.
that will give you actually insight about the consistency of their performance. So a consistent scheme is much better
Okay. Consistent
method of choosing a scheme instead
performance.
of the best performing
Fact
scheme.
sheet. Okay. Perfect, sir.